Hello, good morning dear students. Yesterday I discussed with you what is the basic element of financial management. So how financial management is related to human beings, to corporate. So in yesterday's class, once you remember, financial management is a subject of decision making. There are three major decisions the financial manager has to take: financing decision, investment decision, dividend decision. There are two basic concepts involved in this. One is procurement of funds and utilization of funds. Procurement of funds means raising of required funds at a least cost considering government rules and regulations, risk cost control. Okay. Thereafter, procurement of funds. In procurement of funds, what we discussed, the company has to estimate how much funds should be needed and it has to rise from various sources at a least cost. Whatever the funds it raised, it should not keep idly with it. It has to utilize in fixed assets, in current assets, in such a way that it must generate a return. That return must be greater than financing cost. Okay, thereafter, from the return, after paying the cost, whatever the profit left to it, it has to declare a dividend decision. So the dividend decision includes whether the company has to declare a dividend or retaining it and reinvesting it, and further it will give you the better return to equity shareholders. So this is the dividend decision. Among that aspects in financing decision, we used to learn cost of capital, capital structure, leverages. In investment decision aspects, we will learn investment and how to make investment on fixed asset, capital budgeting, how to make investment on current assets, working capital management. Okay. Thereafter, you have a dividend decision. In order to make analysis, you have a ratio analysis. So these are the chapters which we supposed to learn to take effective decisions. Okay. Now, among this here, our institution follows a certain order where these chapters should be discussed as early as possible. So today, dear students, on the rapid revision batch title, I am going to start capital budgeting. So now we are going to start the first chapter, capital budgeting. Right, dear students, capital budgeting. Actually, it includes the two words. One is a capital, another one is a budgeting. It is also called capital expenditure planning. Capital budgeting means it is a systematic planning to make investment on fixed assets. For example, whenever you are making investment on fixed assets, generally it includes a huge crores of rupees. Can you make investment by making a 1 rupee toss? Tell me, can you make it 1 rupee toss? No. When you are making a huge investment on fixed asset, it consumes a lot of money, right? So before making investment on fixed asset, so you will calculate whether it is worthwhile to make investment or not, because that funds won't come you as a free of cost, right? You have to raise it from various sources. Either if you raise it from bank, you have to pay interest. If you raise that funds by issuing debenture, you have to pay interest. Even if it is a equity, your own funds, it has an opportunity cost. So what the point you should understand here is, whenever you are raising some funds by promising to pay certain cost and you are investing in fixed assets in order to generate a return, that return not only compensate cost, after compensating cost, it has to give some return to you. So that is the basic idea for the capital budgeting. It comes under the category of investment decision. I will give you a small case study. In Dubai, they constructed a palm islands, right? Palm islands which consist of billions of crores, billions of dollars. Whereas by spending more than 10 to 15 years. So they constructed apartments and they sold it. But before this, before construction and selling process, so certainly they would have made an estimation, Let me show you. See, this is the ocean in Dubai, right? This is the Dubai. What the government is planned is, they filled this ocean with some ships, means filled with the sand, cement and concrete. While going on filling, they got certain artificial land like this. It was happened more than 3 to 4 years, only they done the same process. Thereafter, they developed such a land there in the middle of the ocean, try to understand it. And then they started to construct like a villas there, and they started to sell this one. They constructed such a beautiful villas. You see, here you have a car parking, even swimming pools also is there. And they made it such a biggest concept like this, such a biggest concept. Now try to understand is how much of $1 billion they would made investment. Now tell me, would they have made just on only by making tasks just now what I told you? So they would have gone with proper plan by making all these things. Because once you make such a huge investment, right happen, so you have to make a plan. You see here, this man might be a chartered accountant, this might be a banker, this might be a big king of the Dubai, this might be the person who want to make additional investment. These people, all the people, they will come to discussion, they want to know that whether that project is worthable or not. If you are in that place as a chartered accountant, what you do, man? What you do? You will evaluate that whether this project is worthful or not, because crores of rupees you are investing. If something goes wrong, padega bhaiya, you will have a big slap. So that's why you have to learn this chapter to judge such a wonderful project. So evaluate yourself, now itself, evaluate, imagine yourself that you are learning this chapter in such a way that you are going to judge such a greatest huge investment projects, dear students. So that is capital budgeting. If you have the knowledge of capital budgeting, you evaluate such a projects, wonderful projects. So let me come to the topic actually is what is a capital budgeting. See, here the word capital means it is huge. It's not a financial. It is nothing but physical term. For example, capital expenditure, big expenditure. Capital city, big city. Capital, okay, capital punishment. Capital punishment. You see, just 2 days back in Uttar Pradesh, one girl was, what is that? Sorry. No need to that. So, in Uttar Pradesh, some incident was, sir, deni cut chesandi. See, in Uttar Pradesh, some bad incident was happened. Entire the country, the people are making agitation that stupid must get capital punishment. Capital punishment. Capital means it's not a small punishment. It's a big punishment. So here the word also you take in such a way that it is nothing but the capital. Huge. Budgeting means allocation of funds. So when you are allocating huge funds on fixed assets, you have to know that whether it is a worthful or not. So if you come to the here, capital budgeting is the process of evaluating and selecting long-term investment that in line with the goal of investors' wealth maximization. Any company will take a capital budgeting in order to give guidance or judge that whether it is worthwhile to make investment on fixed assets, so that the value or wealth must be increased. Whom value wealth? Nothing but equity shareholders. Here it is also called, what is it? Capital expenditure. It is also called capital expenditure, or you can say it is also called long-term investment plan. Long-term investment plan. Long-term investment planning. So it is called capital budgeting, capital expenditure planning, and long-term investment planning. So while learning capital budgeting as a CA student, what you are going to acquire the knowledge. If you learn this one, you can come to conclusion that how to make investment on fixed assets, and at the same time how to make investment on fixed asset, and how much to invest on long-term funds, and whether it is worthwhile to invest or not on fixed assets. And finally, it is very good for the organization to make investment or not. That everything we can understand by learning this chapter. So example for capital budgeting is purchasing of land, construction of factory and building, and at the same time, not at all, even starting a new business venture. So Dubai government is established, the palm oil and construction is nothing but new business venture. So dear students, from this entire point of view, what you have to understand, what is a capital budgeting? Capital budgeting is systematic investment planning to make investment on fixed assets. It is not current assets. It's make fixed asset. What is a fixed asset? Fixed assets are those assets which will serve the business in long run. Land, building, plant, machinery, all this comes under capital budgeting. Sorry, fixed assets. So how to make The plan for to make investment on that fixed asset is called capital budgeting. If you learn capital budgeting, it enables the financial manager how to invest fixed asset and how much to invest in fixed asset, whether it is a worthful to invest or not, everything you can learn, dear students. This is a capital budgeting, okay. Coming to point is, sir, is it essential to learn the capital budgeting? Without capital budgeting knowledge, can I take any investment decision? I know many of my friends, many of my relatives who are making investment on fixed asset without knowing capital budgeting knowledge. Why should I learn? What is the purpose? Why it is important to me? If you have such a doubt, I will solve this with this slide. See, capital budgeting indicates that before making investment, you have to evaluate now itself that whether it is a worthful or not. Why? Because it includes huge funds, right? The evaluation knowledge if you don't have, evaluation of techniques you don't know, evaluation methods, calculation if you don't know, what you do? You will simply randomly take a decision. Let me, ma'am, I want to buy a pen. I want to buy a apartment. Tell me. Pen is hardly 20 rupees. I never take much attention in buying of pen. Why? Because hardly it is a 10 rupees. Suppose pen won't work properly, what happens? I think that 10 rupees doesn't make any sense, man. But if I buy by spending a 50 lakhs or 1 crore worth of apartment, can I buy as behavioral mode what I used to use for this pen, man? No, because there it is a huge investment. What I do is, I will evaluate whether it is really worthful for me or not, because I am spending that much of amount. After making investment, if I think myself that the decision gone wrong, what happened? I cannot take anything, right? Instead of crying, sometimes making a suicide. Only this the things will happen. But while before making investment, you have to check yourself that, so how much outflow, how much investment I am making, how long this project is going to be in existence, what is the operating cash flow I supposed to generate, what might be the any terminal cash flow at the end of the period I will get it. So you have to considering all these things. If you evaluate now itself, you will get certain financial breathe, financial confidence. So you may refer any of your client that yes, it is worthwhile, I identified, I calculated, make it investment. You can say that. If you don't have a capital budgeting knowledge, what happens? You may say that Bhagavan bachao is bachako. That's enough. So that's why you must learn capital budgeting. Reason is the company, the client who is supposed to make investment on fixed asset, the project or fixed asset which includes substantial expenditure. Substantial expenditure means huge investment. And another one is it is a long-term period. The investment what you make it on fixed asset, it's not a short run. It is a long run. It is going to influence business life over the long period. So when long period influenced decision is there, then you have to take very, very careful assessment. Thereafter, what happened? Irreversibility. Making investment in fixed asset is not reversible. What is the difference between reversible and irreversible? If you make investment, if you won't like that one, and you can get it your investment back. If you get it investment back, if you have such a chance, then it is called irreversible. Reversible. If you won't have such a chance, it is called, what is that? Irreversible. Try to keep it in mind. So investment on fixed asset is not reversible, it is irreversible. So that's why before making investment one time, evaluate yourself 10 times and judge yourself that whether it is really worthwhile or not. That is the most important. Irreversible. Investment on fixed asset is irreversible. That's why now itself you have to evaluate and you have to check whether it is worthwhile to make investment or not. And next one is complex decision. The investment on fixed asset is basically complex. The capital budgeting itself is a complex. So the plan behind making investment on fixed asset is not a simple decision, it is a complex decision. So you have to consider your investment, you have to consider life, you have to consider tax, depreciation, regular operating cash inflow, sales, variable cost, okay, terminal cash inflow, all these things. You have to consider all these things and you have to systematically evaluate by considering all these factors and you have to come to conclusion that whether it is worthwhile or not. So that is the reason. But such a complex decision you can easily resolve if you have the knowledge of capital budgeting. So that's the purpose or importance or need for you to learn capital budgeting is because the investment on fixed assets includes substantial expenditure. That's why you must learn. It is a long-term period. It's not a short-term period. That's why you must learn capital budgeting. Then you have to evaluate. And it is irreversible in nature. That's why you have to learn. And finally, it is a complex in nature. Complex in nature. That's why you have to learn again capital budgeting. Right. The next concept is, in order to evaluate the project, you must learn various methods, dear students. You have to learn the methods. This methods of capital budgeting being classified into two types. One is traditional methods, another one is modern methods. Traditional methods. Under traditional method means these methods ignores time value of money. Here it is there. So ignores time value of money. Here the point is I am making. So methods of capital budgeting. One is traditional methods. Another one is modern method. Under the traditional method, you will have payback period, accounting rate of return, and in modern method, you will have a net present value, internal rate of return, and profitability index, and discounted payback period. So these are the methods of capital budgeting. Let us check. Sir, what do you mean by traditional techniques? How it is different from modern techniques? These students, it's very simple. Traditional techniques ignores time value of money. Since they ignore time value of money, their dominance also decreased in financial management decision making, because it ignores a time value of money. There are two methods under the traditional methods. One is a payback period, another one is accounting rate of return. Thereafter, modern techniques are developed, modern cash inflows, which is called discounted cash inflows, modern cash inflows. In modern cash inflow, you will find NPV, net present value, internal rate of return, which is called IRR, profitability index, which is also called benefit cost ratio, profitability index. Thereafter, discounted payback period. So these are the methods we used to learn. I repeat again, methods of capital budgeting broadly classified into two types: traditional methods, modern methods. Traditional methods means payback period, accounting rate of return. Under the modern method, you have NPV, internal rate of return, profitability index, and discounted payback period. What is the difference between these two? One is that traditional technique ignores time value of money. Modern technique considers time value of money. So modern techniques are very, very popular one. Okay. Right. So these are the methods of capital budgeting, dear students. The next we are going to discuss nothing but evaluation of a project. How do you evaluate a project? In the first slide, I made you to understand what is the importance of it and what is the methods there, how many methods are there to evaluate a project. In order to evaluate a project, so what are the things to be needed? For example, if it is a big fixed asset, right? I want to make it investment on this fixed assets. So what are the things I must consider in order to evaluate a project? Number one, these are the points. First of all, you must know the cash outflow. That is nothing but investment. So how much investment you supposed to make it? Either you have to use traditional methods or modern methods, whatever the methods you may take it. The point is, what are the factors you are going to consider? That is most important. You should get the information from your client. If you are giving advice or if you are making investment, take your own analysis that how much investment I supposed to make it. So dear students, this is nothing but the first cash outflow I used to make it. Thereafter, what is the cash inflow I supposed to get it? If I will make investment, what is the inflow I supposed to get it? That's most important. Cash inflow. And thereafter, I should understand that how long I am going to get it this. How long? Is it 1 year, 2 years? It may call life of the project. Life of the project. You try to understand life of the project means if suppose 10 years are there. It is a 10 years is life. This 10 years you are going to produce a product, you are going to sell into the market, you are going to generate a profit. That is called life of the project. Thereafter, tax. During the over the 10 years or given time period, if you earn profit, right, that from that profit you have to pay legal charge. That is nothing but tax. You have to consider tax. In order thereafter, after deducting tax, you may get the pure profit. That profit may generate in future. Now you have to make investment now. So you have to understand the impact of time value of money. So for that purpose, whatever the cash inflow generates in future, you have to bring into present. If multiple unequal cash inflows generates in future, bring them into present by discounting present value factor. If same equal cash inflow generates in future, bring them into present by multiplying with the present value annuity factor. So whatever it may be, you must consider time value of money. Got it my point? Right. So these are the things. I repeat again. So to make evaluation of a project, what is needed? Tell me. Number one, what is needed? Cash outflow, that is investment. Number two, what is needed? That is what is the cash inflows you are supposed to get it. Cash inflows broadly two types. One is operating cash inflow, terminal cash inflow. That I will explain in the next slide, right? Thereafter, what you have to consider? Life. Thereafter, you have to consider tax. You have to pay tax. And finally, you have to consider time value of money. If you have this knowledge or these concepts, so you can evaluate a project in a easy manner. Okay? Right. The next one, to evaluate, you should understand the cash flows. Cash flows of the project. See, cash flows of the project. Two types cash flows. One is inflow, another one is outflow. The basic rule is the inflow must be greater than outflow. Inflow must be greater than outflow. So here, once you know the inflows and outflow, then only you can come to conclusion. Even if you see the layman who don't know basics of FM, basics of financial system, if you ask them, so whether it is worthwhile to buy that apartment, so what he will say? Sir, you invest now with this amount, you sell there with the given amount. From that given amount, you deduct with your investment amount, you will get the profit, you can make it investment. The layman who don't know A to Z or ABC, not A to Z, ABCs of finance also come to conclusion to make investment because he will compare with the inflows and outflows. But we are the professionals of here professionals. We are a chartered accountant. We cannot compare just inflows with outflows randomly. So we have to evaluate in a systematic manner. For that purpose, you should understand the cash flows of the project. See, dear students, here I would like to say year 0. 0 means beginning of the year. Keep it in mind. Year 0 means beginning of the year. Y1 means at the end of the first year. Y2 means end of the second year. Y3 means end of the third year, and Y4 means end of the fourth year. So this is Y0. You used to make outflow. That is nothing but investment. Thereafter, every year you used to get it operating cash inflow. Means in this year, what happened? You are going to, at the end of the period, we will take an assumption that the sales is going to happen at the end of the period. Even though you will produce the product, you will sell, we will come to conclusion that the sales and associated cost is happen at the end of the period. That is a basic assumption. Basing on that only we can take, we can make evaluation, not take evaluation. So that is, this is called operating cash inflows. Operating cash inflow. Operating cash inflow means this is the cash inflow generated from the operations done by the business. So what is the operation of business? What is the yesterday's slide? What I told you? First of all, you have to produce a product, right? From the production, you used to get the units, right? From that units, you used to sell in the market. You will get the revenue. From the revenue, whatever the cost you used to incur, after deducting finally how much inflows you can generate from the project is called operating cash inflow. Operating cash inflow. Keep it in mind. It is the cash inflow generated by business from its regular business operations. It is not only once. It's not going to be done in once. It is regularly operates. Regularly operates business. From that regular operation, whatever the cash inflow business generates, that is called operating cash inflow. It happens every year. First year operating cash inflow. Second year operating cash inflow. Third year also operating cash inflow generates. But one more point is, here you purchased worth of course 50 lakhs rupees. Over the period you are doing business, the project life is 4th year, right? This assets gets depreciation over the period, right? At the end of the 4th year, the project life is complete. Project ends there itself. Now, there might be a chance that you invested this much. Over the period, asset got depreciation worth of how much? Let us take 40 lakhs rupees. At the end of 4th year, 10 lakhs worth of value will be there, you know. At least if it is depreciated 100%, you can scrap at the end of the period. So there is a one more cash inflow generated, which is called terminal cash inflow. Terminal cash inflow. Terminal at the end of the period. Sometimes the asset what you purchased over the period you utilize it. Asset may get some depreciation. At the end of the period, what happened? You will get certain cash inflows. That cash inflow is called, what is that? Terminal cash inflows. So these are the, every year you used to get it operating cash inflow, every year ending. At the end of 4th year, you will get it, what is that? Terminal cash inflow. So at the end of 4th year, you will have a 2 types of cash inflow. Operating cash inflow, another one is terminal cash inflow. Got it my point, ma? Now tell me, what about the cash flows of the project? Balu sir, cash flows of the project is 2 types. Number 1, outflow, another one is inflow. First we will make outflow, then we will get it inflow. Inflows being again classified into 2 types. One is operating cash inflow, another one is terminal cash inflow. Again question arises here, what is operating cash inflow? This is the cash inflow generated from regular business operations, particularly from the sales revenue. From the sales revenue, what are the associated costs incurred by the business? If you deduct it, the finally what you will get it is called what? Operating cash inflow. So terminal cash inflow means it is not essential, or it is not a regular, it is not mandatory that the asset is going to generate a terminal. If at all, if the given asset might be scrapped at the end of the period, whatever the cash inflow you supposed to generate, which is called terminal cash inflows. So now what to do? Just add your operating cash inflow, add your terminal cash inflow, sum it up both, you will get the total cash inflows. From the total cash inflow, deduct your cash outflows. If at all something left to you is nothing but a profit or income or benefit to you, it means that the project is 100% worthful for making investment. So this is the basic evaluation, right? That's why I explained various cash flows of the project. Got it? So next we are going to study the various cash flows in detailed manner. First of all, cash outflow. So what are the aspects we must consider the cash outflow? Dear students, cash outflow is nothing but the initial investment what the investor is supposed to make it investment. As a chartered accountant student, when you are estimate initial cash outflow, these are the things you must consider. Number 1, what first take cost of asset. Cost of asset. Okay. If at all company makes any installation charges, any investment charges, right? Installation charges or investment charges, that is also you add back it. So cost of asset plus installation charges. Installation charges you should add it up. This installation charges also called setup cost. You add it. Thereafter working capital. This is the very contradiction, dear students. See, generally we used to make investment on fixed asset. But sometimes fixed asset alone cannot generate a return. In order to make return from fixed asset, you supposed to make investment on current assets also. For example, Apollo Medical Showroom is there. Apollo Medical Showroom is a fixed asset. Medicines is a current asset. Chandana Brothers building is a fixed asset. Dress material is a current asset. HP Petroleum Gas, petrol outlet is there. Outlet is fixed asset. Petrol is a current asset. Swagruha Sweets Showroom. Swagruha Sweets Showroom is fixed asset. Sweets are current assets. So some project might need current assets. In the process of evaluation of a project, if that concerned project needs working capital, you add back to that. Okay. So that's why cost of asset you take it. Plus installation charges also is there. That is also part of investment. Add it. And working capital is there. If it is there, add it. Thereafter subsidy from the government. So sometimes when you do any project which is very useful for the society, and even you are an entrepreneur and government wants to encourage you, so in that case government will provide you subsidy. So subsidy means how much investment you will make. The government, basing on current rules and regulations, it may return back a certain proportionate of investment, how much you made it. You mean this, how much of investment you made it from the given project. From that investment, some proportionate they will give you in the form of subsidy. So subsidy indirectly deducts your investment amount. That's why if at all government provides subsidy, you can deduct it. For example, a person is there who produces cosmetic industry, another person who produces FMG sector. The government wants to encourage FMG sector, so government provides a subsidy to FMG sector. Whereas one person starting at a rural area, another person starting at a business starting at the urban area. So government will think that if industries expands at rural area, it's a good to the Indian economy. That's why it provides to subsidy. And one person starts at a labor intensive technology, another person starts at a capital intensive technology. So if it goes with a labor intensive technology, many people will get employment, with effect their standard of living will increase, right? If government thinks that, the government will provide certain subsidies. So these are some examples. This is not an ultimate example, that's a keep it in mind. So these are some examples. Basing on this, government will provide some subsidy. If subsidy is provided, your investment will decreases. Okay. If it is a replacement, you are not going to directly invest on asset. You are going to replace, means replacement you are doing means already existing asset would be there, If you scrap it out, that asset, you will get certain inflows. That inflows also you can deduct it. So this is the initial cash outflow. Tell me initial cash outflow. Step number 1, take cost of asset. Number 2, any installation charges are there, added back. Number 3, if at all project demands working capital, it is not mandatory that all the project need working capital. If it is demands, so add back that working capital also. So cost of asset plus installation charges plus working capital. From that, deduct if government provides a subsidy, deduct it. If you are going for replacement, already existing machine would be there. If you would have scrapped that machine, you would have got some amount. That amount also you can deduct it. So this is the initial cash outflow. Got it? This is the way you have to understand. Read this one and write in your notebook in a better manner. This is the initial cash outflow. Thereafter, what you have here, the most important point I would like to share with respect to working capital. Working capital is nothing but the current assets which is needed. Just now I discussed with you. This working capital, how we can make a treatment means, initially we will make investment. If we make investment on working capital, you have to add back to investment. But while going on project, if you render the project over the period, this working capital will remain constant. Amount may changes. For example, let us imagine I am starting a petrol outlet. Fixed building is fixed asset. Petrol is current assets. So for building I spent 1 lakh. For petrol I spent, imagine, 20 lakhs rupees. So my shop is open, the customer came, I sold my petrol, right? Petrol is finished. Can I close the shop now itself? I can't close, Why? Because, sir, petrol is out, sir. Petrol sale is over. So no petrol. But for that sake of again to buy a petrol, can I make additional investment? Tell me, can I make additional investment? I cannot make additional investment because initially I made it 20,000 rupees investment. With this 20,000, I purchased petrol and I filled in tank. Now I sold it. Let us imagine the same price. Now petrol is finished means I got cash in my pocket, Same, the 20,000 I will get it. If again I want to buy the petrol, can I go for additional investment? Can I spend that given amount itself? The given amount is sufficient for me, right? So working capital means it may circulate. If petrol is not there, then cash will be there in my pocket. If cash is not there means petrol will be there. Same logic, if you take, it may circulate. Asset to cash, cash to asset, but it will be same. But the end of the period, if we are going to wind up the project, at the time also, you will have exact same amount of working capital, how much you made it investment in the beginning itself. That is the most important point you should understand. So, dear students, keep it in mind, working capital will remain same over the period, but it may changes its position. Current assets to cash, cash to assets, it may changes the position. At the end of the period, when you are going to scrap the project, if whether you are going to scrap your fixed asset or not, but absolutely you are going to recover your investment, how much you made it. How much you made it, that's important point. 100% you are going to recover. If nothing is clear, recover percentage or recover amount is given. If not given, you can take it. If it is a given, go with that amount. If not, then go for assumption. That's why, dear students, it is important to note that the project may also require additional working capital during its life in addition to initial investment. Working capital is the amount of current assets needed for the smooth running of fixed assets. What is its treatment? Step 1, added to initial investment. Step 2, recover it from your terminal cash inflow. At the end of the period, you can recover it. Got it? Right. Thereafter, operating cash inflow. So this is the wonderful operating cash inflow. Just now I told you why the title is given operating cash inflow. These are the cash inflow generated from the business operation itself. Here you see the operation cash inflow means you will have sales revenue first of all. Sir, can I take credit sales? No, you have to take only cash sales. Cash sales. So from sales revenue, take it sales revenue. From the sales revenue less you deduct what? Variable cost. That the variable cost, or you can say direct cost, or you can say manufacturing cost. Manufacturing cost. From sales revenue deduct variable cost and or direct cost or manufacturing cost. After deducting from sales revenue variable cost, you will get a contribution. From that contribution, you deduct what is that fixed cost. If at all fixed cost is there, deduct that fixed cost. You will get it a profit before depreciation and tax, which is called PBDT, which is also called operating profit. Why it is called operating profit means just you deducted only operating costs. Operating cost means variable cost and fixed cost. So whatever the profit the company generates by deducting only its operating expenses, that profit is called operating profit. Okay, operating profit. Thereafter, you are liability to pay tax on operating profit. In order to reduce the tax burden, you can show depreciation as a non-cash expenses. Depreciation generally a non-cash expenses. In capital budgeting in evaluation of CFAT, means operating cash inflow, we never consider depreciation. But if the problem have tax, in order to reduce the taxable income burden, what happened? We will reduce the depreciation. Keep it in mind. When there is a tax, there is a depreciation. When there is no tax, there is no depreciation. Depreciation is a purely tax allowable expenditure. We never consider depreciation, but we do only in the presence of tax. So here you see, from the PBDT we liability to pay tax. What I have done? I deducted depreciation. After deducting, I will get the PBT. From the PBT pay tax, you will get the PAT. This PAT is called accounting profit, profit after tax. So this is the profit you got it, but you already deducted amount in the form of depreciation, which is also in your pocket. So you have a PAT, you have a depreciation. So you want to know how much cash inflow you generated from the business. So what you do, from this operating cash to this operating cash inflow, add your depreciation. Because depreciation is not expenses. Only for the sake of tax you made a treatment. So you deduct it, you will get the CFAT. This CFAT is also called cash profit. The CFAT abbreviation full form means cash flow after tax. Cash flow after tax. PBDT you will get it only from the sales revenue if you deduct only your operating expenses. That is nothing but variable cost and fixed cost. From the operating cost, if you deduct a legal cost, tax, and non-cash expenses, depreciation. By deducting depreciation and tax, whatever the profit, you will get it by again add backing depreciation. That is called CFAT. This is called cash profit. Okay, this is estimation of operating cash inflow. If business life is 10 years, keep it in mind. Business life 10 years means every year, business generates the same profit. Same profit. Not exactly same profit. Same business operations. If we do, from that deducting all the revenue, for all the cost from its sales revenue, how much profit it generates, that is called operating cash inflow. Thereafter, one more thing is left out, is called terminal cash inflow. There is a one more cash inflow, terminal cash inflow. Kidhar gaya? Terminal cash inflow. See. Terminal cash inflows. The word terminal means lost. Lost. End. Or lost. So at the end of the period, if you have an asset, if you scrap it out at the end of the period, how much cash inflow you generate, that is called what? Terminal cash inflow. How do generally corporate companies estimate this one? I will show you here. See, estimation of terminal cash inflow. Estimation of terminal cash inflows. Actually, I made a PPT for that. I think it missed. Okay, terminal cash inflow. This is, we can take format like this. What we do is take particulars and amount. See, you purchased asset in the given time period, right? Here you purchased asset. So over the period of 5 years, you used this asset. At the 5th year ending, you sold this asset for the given amount. So, or else you purchased this asset and you used for the 5 years given time period. At the end of the period, you are supposed to get the cash inflow or some cash inflow. How much at the end of the period you supposed to get by scrapping the asset what you purchased at initially? That is called terminal cash inflow. Here what you do is you will take a gross sale proceeds. Gross sales proceeds. Gross sale proceeds. Let us say, imagine you sold the asset for 1 lakh rupee. This is a gross sale proceeds. You sold it in the market. Once you sell in the market, the government people will approach you. Hey, Balasubramaniam, tax pay karo mere ko. You sold this asset, pay the tax. So government will come to you. Then you say that you should not pay tax on sales proceeds, but you pay tax on the gain what you generated from the given transaction. So what you do is immediately you have to find it out. What is the written down value? Written down value means the value of asset at the time of scrapping in the market. That is called written down value. So what we do is you have to estimate written down value. Sir, how do we calculate written down value? It's very simple. Written down value, it indicates the value of the asset at the end of the period. What you take? Take the cost of asset. This is here, the asset would be there. Investment, how much you made it from the cost. Over the period you use this asset, the asset would have been depreciated, right? So you accumulate that depreciation amount. Accumulated depreciation. How much the depreciation you got it, you take that entire balance. Let us imagine the company purchased asset is worth of 5 lakhs rupees. 5 lakhs rupees. Over the period, that may be 5 years and 3 years, the company asset got the depreciation worth of 4,50,000 rupees. Asset got the depreciation. Now tell me, 5 lakhs they purchased asset and 4,50,000 asset got depreciated. Now at the end of the written down value is how much? 50,000 only. 50,000 only. But the point is, for how much you scrapped in the market? For how much you scrapped in the market? You scrapped that asset for 1 lakh rupee, right? You 1 lakh rupee you sold in the market. But its written down value is 50,000 rupees. So how much you got the gain or loss? You got the gain. So C point is identify how much capital gain you got it. Capital gain. By deducting A minus B, you may get it a capital gain. If you get loss, then it is called capital loss. So now you take it. Let us imagine here 50,000 worth of you are selling at 1 lakh rupee. You got the gain of 50,000 rupees. From this 50,000 rupees, government will ask you to pay tax. Let us pay tax. Let us imagine tax rate is 50%. 50% means how much you will pay? 25,000 you will pay. So this is the taxable, you pay it. Now you tell me, you sold the asset for 1 lakh rupee. 1 lakh rupee is in your pocket. So now your liability to pay only 25,000 of tax. Let us imagine how much of net sale proceeds you used to get it. From net sale proceeds, if I ask in regular classroom, what the student do is 25,000, sir. Why? Because 50,000 you got the gain and 25 we are paying and finally 25. No, wrong like that. So you have worth of 1 lakh rupees in your pocket because of scrapping asset. Now your liability to pay tax on capital gain is just to 25,000 rupees. Now you can take it the net sale proceeds. What you will get it? Net sale proceeds. Net sale proceeds is 1 lakh rupee minus 25,000. So 75,000 is the net sale proceeds you used to get it. So this is the value of asset you are going to get at the end of the period. At the end of the period. If at all working capital is there, then you can also recover the working capital. Recovery of working capital. Recovery of working capital. Suppose you made it investment 1 lakh rupee, you can also recover. This is the 1 lakh rupee. So finally you will get it 1,75,000 rupees as a terminal cash inflow if you get a profit, gain. Not profit, it is a gain. Suppose, if it happens in a reverse, you sold asset for 50,000 rupees, 50k, whereas asset worth is 1 lakh rupee. In that case, what to do, sir? 1 lakh rupee worth you are selling at 50,000 means you got the 50,000 loss, right? 50,000 loss. In this case, you may take an assumption that whenever you got a profit, you are paying a tax, right? Whenever you will get a loss, government also wants to encourage you. In that case, you can take an assumption that the government will provide you tax shield. Tax shield means a benefit you are going to get it. So how you are going to get it, how much you are going to get it, now itself we are not going to project it because we are making a plan. By chance, aisa hua to. And by chance, if it happens, at the end of the period, you may get the tax shield, right? End of the period, you may get the tax shield. In that case, you got the loss 50,000. The government will provide you, may provide, I'm not guaranteed. But I will take an assumption that if at all, government provides you tax shield, 50%. 50% means already you got the 50,000 loss. So government provide you 25k as a tax shield to you. In this case, you have a double income. One is you sold asset for 50,000 rupees and government gave 25. If it is a net sale proceeds, if at all tax shield is there, here it would be plus tax shield, you have to add it. In this case, what we do is, so in this case, what happened? You sold asset for 50,000, take that value, and plus government provides 25,000 tax shield, add back to it 25,000. So in total, you will get it 75,000 rupees. So this would be the net sale proceeds if the procedure is like this. So this is the way you have to find it out, the terminal cash inflow, dear students. Point number 1, gross sale proceeds. Gross sale proceeds means this is the amount the company might recover by scrapping the asset at the end of the period. If government asks you to pay tax, then you calculate a written down value. Written down value is nothing but cost minus accumulated depreciation. So this is the value of asset at the day of scrapping of asset. That is written down value. You compare both, you may get the capital gain or capital loss. If you are selling your asset more than its written down value, then you will get the gain, you are supposed to pay tax. So you are selling an asset less than its written down value, then you are getting a loss. You may take an assumption, you may get the tax shield. Tax shield is an income inflow to you, tax is an outflow to you. Whatever the gross sale proceeds is there, if you get the gain, you have to pay tax. Gross sale proceeds minus tax is nothing but net sale proceeds. If you get the advantage, tax shield, you will get it. Then gross sale proceeds plus tax shield, that would be your net sale proceeds. So now, whatever the cash inflows I calculated in front of you, so operating cash inflow and terminal cash inflow, add back both, you will get the total cash inflow, compare with your cash outflow. So from the, if you deduct the cash outflow, how much value left to you, that is nothing but a benefit because you are supposed to enjoy by undertaking this project. In that case, you may say that since net benefit you are getting, this project is worthwhile. This is the basic idea for evaluating a project. I discussed with you how to calculate the cash flows of the project. The students, the cash flows of the project being classified into two types. One is the cash inflows and cash outflows. Cash inflows again classified into two types. One is the operating cash inflow, another one is terminal cash inflow. Cash outflow you will make in the beginning, and over the period you used to get it operating cash inflow. At the end of the period you will get it terminal cash inflow. So today we are going to learn how to calculate the cash flows of the project. This is the first model. Generally we do this two problems in regular or classroom. So here I am going to take one problem. So from this model I am going to take the problem number 2 for you. A firm buys an asset costing of 1 lakh rupees. This is the problem. For better effective teaching, I made it a PowerPoint presentation for you. Same problem here itself. A firm buys an asset costing 1 lakh rupee. You try to get it. 1 lakh rupee is the investment. And expects operating profit. Operating profit means what profit? Profit before depreciation and tax. PBDT. From the sales revenue, if you deduct operating expenses, whatever the profit left to you is called operating profit. So how do you get the operating profit? Yesterday I showed the format, right? From sales, you deduct variable cost, you will get the contribution. From the contribution, deduct fixed cost, you will get the PBDT. So that would be called operating profit, right? From that operating profit, you have to pay tax, right? Before paying tax, you have to consider depreciation. Here the problem, what is saying, tax rate is 30%. The student, 30% tax rate is there. Then you have to consider the depreciation is written down value. There are two methods generally exist in calculation of CFERE. One is a straight line method, another one is a written down value method. In straight line method, cost minus scrap divided by life. This formula, by using this formula, we will find it out, the annual depreciation to be charged. So every year, depreciation amount will remain constant, same over the period. Whereas in written down value, it's not like that. Every year, the amount of depreciation gradually decreases because asset value also decreases. Here we used to calculate depreciation basing on written down value. That is, keep it in mind, since depreciation is a tax allowable expenditure, in this problem tax data is available, that's why you must consider depreciation, right? The life of the project is 4 years, which the asset would be disposed of at the end of 4th year is at 45,000. Find out the cash inflow of different years. So the life of the project is 4 years, means every year you are supposed to get an operating cash inflow. At the end of the period, you used to get the terminal. Here the asset, you are going to scrap it out for 45,000. In this given transaction, if you get the capital gain, you are supposed to pay tax. If you get loss, you are supposed to get what? Tax shield. That's we are going to find it out. Finally, asking us to find out the cash flows. I repeat again, the cash flows of the project would be first outflow and inflow. Inflows being again classified into two types. One is operating cash inflow, another one is terminal cash inflow. Let's check it in this problem. Estimation of relevance cash flows of the project. This is the first one. I took the statement. Step number 1, estimation of initial cash outflow. Initial cash outflow, how much the initial cash outflow you made it? So that is nothing but cost of asset. Cost of asset is how much? 1 lakh rupee. 1 lakh rupee. There is no installation charges. There is no working capital. There is no subsidy. And there is no, we are not going for replacement because of existing machine also, you may scrap it out. That's why, dear student, nothing is given. That's why you can take directly the cost of asset is the step 1, that is estimation of initial cash outflow. Thereafter, what you have to find it out is estimation of operating cash inflow. Estimation of operating cash inflow. Let's come to operating cash inflow. Here you see it. Estimation of operating cash inflow. I took particulars. Here year 1, year 2, year 3, year 4 I took it. First in this problem, they have given PBDT, profit before depreciation and tax. For first year, second year, third year, every year depreciation amount remain constant. That's why I took here first year 30,000, second year also 30,000, third year 30,000, fourth year 30,000. Every year I took the PBDT. From that, I have to deduct a depreciation. Okay, depreciation is at what percentage? 20% is given in the problem. So actually, you purchased asset for how much? 1 lakh rupee. 1 lakh rupee into 20%. 20%. You will get the 20,000 depreciation. So here the asset value would be 1 lakh rupee. Again, you have to calculate the next year depreciation on its written down value. It means that from the 1 lakh, if you deduct 20,000, you will get 80,000. From this 80,000, again you have to calculate 20%. So like that you used to, while going on, while whatever the written down value will exist on the concerned year, basing on that you have to calculate depreciation. But every year, if you finding of written down values will consume your valuable time, dear students. For that purpose, I will give you a small strategy. See, every year asset depreciates by 20%, right? Got it? My point? Every year asset depreciation by 20%. So why don't you think like that? If first year asset depreciation would be 20,000. This 20,000 is estimated on the value of 1 lakh. The point is, the next year asset depreciate by with 20%. In that case, the whatever the first year depreciation you also calculated, this also will depreciate with 20%. Depreciate by 20%, same. So in this case, what you do is, instead of finding written down value again from first year, second year, third year, fourth year, by wasting your valuable time, why you waste valuable time? So you try to find the logic. If asset depreciates every year, okay, and at the same time estimated depreciation also decreases by 20%. In this case, let's take the first year. I took 1 lakh into 20%. I got that 20,000. So next year, what happens? This 20,000 depreciate by 20%. In this case, instead of finding written down value, what I do is I will take the 80%. Same value. So next year again, asset gets depreciation by 20%. So depreciation also decreases by 20%. In this case also, you can take the 80%. Thereafter, you will get the 12,800. So 12,800 into 80%, you will get the next value. So every year assets gradually means 20%. Every year assets systematically decreases. That you have to find it out. So first 20,000, the same value you will get it. So first year 20,000. From this 20,000 multiply with the 80%, you will get it 16,800. 16,000, then multiply with the 80%, you will get it at 12,800. Multiply with the 80%, you will get it at 10,240. So you got the depreciation that you have to deduct it. So in deduction process, either you have to write less or you will show the bracket here. So I am showing bracket here, I am deducting it. So from the depreciation, if you deduct from the PBDT, if you deduct a depreciation, you will get the PBT. 30,000 minus 20, you will get the 10,000. 30,000 minus 16,000, you will get the 14,000. 13,000 minus 12,800, you will get the 17,200. 30,000 minus 10,240, you will get the 19,760. So let's take the tax rate. Tax rate is available at 30%. So 10,000 into 30%, you will get the 3,000. Whereas 14,000 into 30%. 30%. 4,200. Again, 17,002 into, you will have 30%. You will get 5,160. Thereafter 19,760, 19.760 into 30%, you will get it a 5,928. All the values are accurate. So even though I showed here, I'm calculating, I'm showing you. So you can also calculate at the time. So tax, you deduct this less tax. After deducting this tax, what you will get it? 10,000 minus 3,000, 7,000. 14,000 minus 4,200, 9,800. 17,000 minus 5,160, 12,040, 19,598, 13,832. So you will get it. Now if you want to find the CAT, you will get the PAT, right? You got the PAT. For the PAT, you have to add back what? Depreciation. Since depreciation is a tax allowable expenditure, tax treatment is finished. So you can add back it now. So add back depreciation. Here depreciation value 20,000 and again 16,000. Again 12,800 and 10,240. By adding this one, you will get the CFAT. First year 27,000, 25,800, 24,840, 24,072. So this would be your cash inflow to be estimated from the given problem, right? So first to take PBDT. From the PBDT deduct what? Depreciation. You will get the PBT. From that direct tax, you will get the, what is it? PAT. Add back to depreciation, you will get the CFAT. This is the procedure to calculate it. One thing left out is, that is nothing but terminal cash inflow. You see here, estimation of terminal cash inflow of the project. Yesterday I showed the format how to calculate. The same thing I am going to project here. Gross sale proceeds. How much gross sale proceeds? 45,000 rupees. 45,000 is the gross sale proceeds. So you are going to scrap the asset, but immediately the government people will come and they will ask you pay tax. In order to pay tax, we have to find it out whether we got the gain or loss. If we got the gain, we will pay tax. If we got the loss, we will take a tax shield from the government. So we will find it out written down value. Written down value is nothing but cost minus accumulated depreciation. So cost is 1 lakh. Accumulated depreciation means first year 20,000, 16,000, 12,800, 10,240. Add back all. You will get it, you see it. 20,000 plus 16,000 plus 12,800 plus 10,240. You will get it 59,040. 59,040 you will get the value. So what, from this 1 lakh, if you deduct 59,040, you got the 40,960. This would be the written down value. What do you mean of this? So on the day you are scrapping the asset, on the day at which you are scrapping the asset worth of 45,000, whose asset value is just 40,960, but whereas you are scrapping this asset for 45,000, so you got the capital gain. How much? 45,000 minus 40,960. So you got the gain of 4,040. This is the 4,040, you got the gain. Then you have to pay tax, man. You have to pay tax at 30%. So into 30%, you will have 1,112. You will have the 1,112 is the tax. So actually you sold the asset for 45,000. It is there in your pocket, but you have to pay tax 1,140. Now what to do is, after paying 1,212 from the 45,000, the net amount available to you is would be 43,788. Generally what happens, the students, the way of thinking is, they will start to deduct this one from 4,040, because in top 4,040 is there, in down 1,212 is there, just simply deduct it. No, you should not do it. You should try to understand. You are scrapping the asset for 45,000. In the given transaction, your liability to pay tax 1,214. So from 40,000, if you pay 1,212, what is the amount available is 45,788. Now let's come to the conclusion. So how much investment initial cash outflow you made it? 1 lakh. What is the total operating cash inflow you got it? 27,000 plus 25,800 plus 24,840 plus 24,072. By summing up of all this value, you will get it 1,01,712. You can calculate it. 1,01,712 is your operating cash inflow. Whereas the terminal cash inflow, you got it 43,788. Now you can come to a conclusion that these are the just cash inflow. This is the procedure in which we have to find it out, the cash inflow actually. Now here itself we can come to conclusion that whether the project is worthwhile for investment or not. How do you say? For example, you got the operating cash inflow 1,01,712 plus terminal cash inflow 43,788 minus cash outflow would be 1 lakh. So you will get it 45,500 rupees surplus cash you are generating by undertaking this project. So basically here itself we got a positive point that this project is worthwhile for investment. So this is the problem through which we learned how to calculate the cash flows of the project.